So let's stay on Scott Bessent. My next guest has actually discussed Bessent recently and Treasury and a rally in the markets in a recent edition of his Dividend Cafe podcast. So I want to bring in a Bahnsen Group, their managing director, David Bahnsen. David, so just a perfect topic for you. You just had this conversation with your subscribers and others.
Yeah, I mean, I've been real focused on it even since the election because I think Secretary Bessent is exactly what you said at the top of the show. He's someone who understands financial markets, and he understands that not only do they tell you things, but then you can use financial markets to affect policy. Very, very smart guy.
So let's talk about tariffs. It's so funny because I saw a piece from Bessent a year ago. He's like, hey, hold off on these things, right? This is from this one is from Goldman. Yeah. A lot of folks putting work out there, and their work is always great. Their baseline showing, I think, like a 4.7 percentage point basis point move, but also on the other side of this, just moments ago, maybe an hour ago, the EU offering to lower their tariffs on U.S. cars. So there's a negotiating part of this, and then the actual part of this. I know you're not a tariff guy, but what do you make so far of the way the markets receive them and just the role they may play over the next couple of years, particularly this year?
It's funny. You mentioned my dividendcafe.com. My whole entire issue today is about this. There's two different things going on. There is the tariffs as negotiation. You can't have a market impact with tariffs that don't become tariffs. If they're negotiating, then they're not tariffs.
Right.
So there's that issue, trying to affect better policy outcomes, Mexican border control, Canadian drug control. That's a separate story from if we were to. So when people like Goldman are trying to analyze the impact of tariffs that aren't going to happen or haven't happened, or if they do happen, like in 2018, they made 1 million exemptions, we don't know what the impact would be. So you're right, I'm an anti-tariff guy, but I don't believe the president is here to do tariffs to affect trade policy. So far, he's exclusively using tariffs to affect domestic policy.
Well, one thing on the domestic side that they're squarely focused on is crude oil. This is pretty intriguing. So the inauguration was right around here, and we've essentially gone down over 10% on crude.
Yeah, but it's exactly to the penny where it was the day of the election.
The day of the election.
The day of the election. Hasn't moved since President Trump
was elected.
What
do you make of it, though, that it's come down this much? And by the way, in the last month also, energy has given up a lot of its gains. This is in the last 5 days, particularly, the energy is starting to give up some of its gains. I know that there's a sweet spot, and we talk about, no pun intended, for oil crude. Yeah. You don't want it too high, you don't want it too low.
That's right.
But they would like to see it lower, the administration.
Yes, they would. And it's a frustrating thing when you don't have a state-owned oil industry because you're not going to go get the Exxons and Chevrons to do 3 million more barrels today at 70. At 85, they'd love to, and then that would bring it down. But that's the complexity of supply-demand imbalance. Charles, Chevron's up 5.5% this year. Exxon's up 2%. The midstream people are up 4.5%. There's a lot of great things happening in energy, but those smaller producers that don't have the pricing power as Chevron and Exxon, they don't make as much at $70. They want higher. The president would love to get lower priced oil. It's going to be tough to get there. But when you say it's down 10%, that's from 78 to 71. That's a great range for consumers, right in the 70s. It's not very volatile in the 70s.
Could you live with 65?
Exxon could, but some of the smaller producers in the Permian, they 65 cuts into margins.
I mean, but you think about like Alberta, right? I had a guest on say Alberta's got all this oil, but like the tar sand stuff. I mean, that's hard to refine, that kind of stuff.
It's very hard to refine, and so the margins are not there at 60. 65 is a little better, but the 70 seems to be the sweet spot. No pun intended.
Let's talk about a couple of your ideas here, Mullis. More and more folks are talking Mullis. Is this a sort of more Wall Street activity, more mergers and acquisitions? We keep hearing that this is the year it's going to happen.
Well, it was a pretty darn good year last year too, up over 70%. So it's an investment bank that does nothing but advise on acquisitions. And then they pay out all of the profits and dividends.
Right.
And so it was only about a $4 billion company when we bought it. Very, very small compared to like a $150 billion, investment bank. But they had great results this week. They've added a bunch of new investment bankers. M&A is up. Private equity is doing a lot of deals. Moelis is paying all the profits and dividends. We love the company.
Simon Properties, I think this could be counterintuitive. Everyone says a death on the mall, which has been going on for 3 decades now. But if you go to the mall, it's changed. And what they're doing is friendly. They bought a lot of these stores themselves. and they're retrofitting them. There's going to be near me a big Nerf. The whole floor is going to be like a Nerf park, and I'm going to sneak in there and play with the kids.
It's one of the most brilliant reallocations of resources I've ever seen. Buying it at $50 during the COVID moment, and now it's sitting here near $200 and paying that 6-7% yield along the way.
Right.
But when people say death of the mall, they have to stop saying it. They're making fools of themselves. Highest occupancy they've ever had. Highest per foot rent they've ever had.
Wow.
So if that's dead, I want more of that.
I hear you, my man.
Good to see you, buddy.
Unlike Yardeni, you're dressed for the weekend. See you soon. Thanks a lot.